Good morning to all of you. I am Dr. Ashutosh Agrawal from ITERC College of Management, Ghaziabad. Today, I am giving a lecture on industry analysis and company analysis. Comes under the subject of investment analysis and portfolio management KMB FM 01. This is topic is consist of second unit. Today, I wish to deliver the content and the concept, what is the importance of analyzing a company and industry while making the investment. Because once an investor wants to make the investment in an economy, in a company, in a stock market, definitely that investor has to analyze the industry, company, economy as a whole to know about the fundamentals, the fundamental value of an economy, the fundamental value of that particular stock. So, the outcome of our lecture after the end would be what is the importance of analyzing an industry or a company. So, let us start with the industry analysis and company analysis. Industry, what is industry? Industry is the homogeneous group of companies or organization producing the same types of product or service through same production process that constitute an industry. Take the example of automobile, four-wheeler industry. Under the four-wheeler industry, the passenger vehicle industry, the automobile industry. These comes under the automobile industry. So, under the automobile industry, there are various companies constituted like Maruti Suzuki, Hyundai, Toyota, Mahindra and Mahindra, Tata Motors Limited. So, these are the various companies which are the homogeneous group of companies. These are having the homogeneous production process, their products are same, but these constitute a particular industry called as the automobile industry under four-wheeler industry. So, industry analysis is done based on the stage of a particular industry under various industry analysis life cycle. The industry is also having a life cycle. Industry may be under the pioneering stage, the expansion stage, maturity and stabilization and declining stage. Take the example of 98, 99, once the telecommunication industry was under the pioneering stage. The mobile towers starts to establish in various areas of the country. Once talk about the biotechnology, the industry under the maturity stabilization stage. Take the example of jute industry, that industry under the declining stage. Now, the industry revival has come up for the jute industry. Once the eco-friendly products are come out in the market, once a new innovation of eco-friendly bags, eco-friendly things are come out, the jute industry has been revived after the declining stage. So, industry is facing various stages like the pioneering or startup stage, the growth or expansion stage, maturity and stabilization stage and declining stage. This stage starts from, this is the pioneering stage where the risk is high, the investment is high, the return would be low, because the advertisement expenses, the promotional expenses will be high. Under the expansion stage, various new competitors entered into the market, and up to the stage of maturity and stabilization. This is the stage of maturity and stabilization. If we draw, there could be three stages. This is 1, this is 2. So, under the first stage, it is called as the growing maturity. It is called as growing maturity, and this 2 is called as decline maturity. Under this stages, under the growing maturity stage or decline maturity stage, the investment pattern or the return pattern from that particular industry is being decided. So, first is the pioneering stage. Let us discuss one by one. Under the pioneering stage, this is the highly risky stage, because the investment is high, industry is just come up, whether the industry will grow up or just dump out. Second is the startup phase. This startup phase, because under this startup phase the industry is starting their ventures, industry is calling various companies to come up and start the venture. Take the example of pioneering stage of online trading, online marketing companies, online shopping portals, industries. So, under this like Amazon, Flipkart, these are the various companies who are under the startup phase in the economy. So, these industries, because these are the they are under the growth stage in the Indian economy, but previously these were under the startup phase, because the Indian customer is very keen about buying the product, physically buying the product. They are not sure or they are not comfortable for buying online buying, but now the trend had been changed and the consumer is moving towards the online shopping. Under the pioneering stage, due to the promising return, many entrepreneurs enter the chaotic competition. Under this stage, there is a very huge competition, chaotic, very stiff competition under the pioneering stage, because the companies are entering into the market, companies are entering into the industry only with an expectation of promising return from that industry. New technology and new product. Under this pioneering stage, new technologies come out and with the help of new product, but the rate of return is very low. And the real thing is, because rate of return, the reason of low rate of return is because industry wants to establish itself. At the time of establishing, at the time of startup phase, at the time of pioneering, every industry wants to return as low as possible, so that it can be stable for the long term. Once industry starts earning higher rate of return at the pioneering stage, definitely the future will be in dark. Second stage is the growth and expansion stage. This is the stage of rapid growth. Once the industry is moving, grow at a rapid pace, at a higher rate, the return will become high, the demand of a product will be high, and the good investment opportunities for the investors, for the entrepreneurs, for the companies. So, under this growth and expansion stage, there is a very high competition, and as many as competitors has entered into the market, into the industry, which has increased the competition and lowering the return. But under the growth stage, companies are able to increase their return, companies are able to increase their market, companies are able to increase their market share, and under this growth stage or expansion stage, companies always tend to become a market leader. Third is the maturity and stabilization stage. This is the stage where the industries are stabilizing itself, where there is a doubt whether the industry will revive or where the industry will go under the decline phase. Under this, industry grows with the economy. As the economy grow, the industry grow. Means, as per the economic movement, the industry movements will happen. Obsolete technology and product. Under this maturity and stabilization stage, the technology used in that particular industry, the product of that particular industry become obsolete. Means, the new products, the customer is demanding new and new products, new innovative products. Customer wants to change the product. Take the example of feature phones. Under the feature phone industry, the consumer tends to become more innovative, more modernized, and want to use the use of smartphones. So, feature phone industry, the technology of feature phone and the product has been obsoleted. Hardly there is a if we are accepting the rural India, then most of the Indians, most of the consumers are having the smartphones, because the obsolete technology and product. So, we may say the feature phone industry is under the obsolete technology or product, or in the maturity and stabilization stage. Under this feature phone industry, the industry is now making new innovations in the feature phones. They are come up with those features which look like, which makes the feature phone as a smartphone, where the consumer can use the phone as a feature phone along with the smartphone. So, under this obsolete technology and product, the consumer, the industry under the maturity and stabilization stage. Next is the return are comparatively low. Under the maturity and stabilization stage, the returns are low because industry is in dilemma whether they would go decline or they would revive. Under the demand of the commodity is stable, but there is a fear of decline in the demand of that particular product, sign of disinvestment. Under the maturity and stabilization stage, once this second phase decline maturity, under the decline maturity there is a sign of disinvestment. This is a sign of disinvestment. So, when the industry under the decline phase, that is a clear cut sign for disinvestment, the selling off, the turn off of the company, turn off of the industry and the selling off of the industry. Fourth is the decline stage, where the demand become low and return become negligible. So, these are the 4 stages of the industry, and as per the stage of particular industry, the investor will decide whether to invest in that particular industry or not. Means, as I have taken the example of telecommunication industry, the online retail industry, the organized retail industry, the online retail industry, online shopping portals, online marketing industry, or we may say the feature phone industry, biotechnology, jute industry. So, these are the various industries which come under various categories. Say for example, on retail industry, organized retail industry under the pioneering stage and move towards the growth stage, because there is a very high scope under the organized retail industry. Henceforth, big corporates have entered into the retail industry. If we are talking about the biotechnology industry are still in the trough and they are declining. Once we are talking about the jute industry, they are under the revival stage, and again after the declining they have starts reviving itself. So, according to the industry, the investor wants to make the investment. As the investor wants to make the investment, they are benefiting by the economy or the industry or the company. So, the stock movements, the stock lies in that particular industry. The industry we have to analyze, and as an investor has to analyze whether that industry lies under the pioneering stage, growth stage, stability stage or the decline stage. So, these are the basic industry analysis indicators: structure of the industry, past sales and earning performance, attitude of government means government policy, nature of competition in that particular industry, cost efficiency and profitability of the industry, the labor confidence, labor availability in that industry, like chemical industry, the low labor availability is there, performance of the industry in the overall market, stage of industry life cycle, technology and research used in that particular industry, what is the stage of technology, what is the updation of the technology, availability of inputs of an industry and the stability, is the industry is stable or not. So, these are the industry analysis factors. After analyzing these factors, an investor is deciding whether that industry is a strong industry, weak industry, stable industry, whether should we move further ahead for the investment or not. Next is the company analysis. This is divided in 2 parts. Company analysis is, the company is an individual unit being governed by a private player or the government. The company is an individual identity, company is a legal entity created by law and dissolved by law. Once an investor want to make the investment, firstly the investor will go for the economic analysis, then under the economy the investor will go for the industry analysis, then the third is the company analysis. Under the company analysis of a particular unit, particular industry, particular company, particular identity. That company analysis is divided under 2 aspects: financial aspects and non-financial aspects. Financial aspects related with financials, profitability, financial figures, financial output of the company. Non-financial aspects related with qualitative aspects. Financial aspects like the quantitative aspects. So, financial aspects, let us start with the financial aspects of under financial analysis. Under the financial aspects, the investor has to analyze the solvency position of a company. Solvency position of a company is the long-term paying capacity of a company, long-term debt paying capacity of the company. There are two sources of capital, equity source and debt source, borrowed source. Once the source of capital has been sourced from borrowed source, it can be from the debentures, bonds, loans, public deposits. So, these borrowed source of capital will talk about the solvency position, how effectively the payments can be made, how effectively the borrowed source means the repayment of debentures holder, repayment to bond holders, repayment to loan can be made. So, solvency position talk about the long term paying capacity. Long term paying capacity may include borrowed source of capital, borrowed source of capital like debentures, bonds, loans, public deposit. So, these are the various borrowed sources of capital under which the company will analyze whether they can repay their debts or not, whether they can pay the debt or not. Whether they can pay the debt or not. So, solvency position talk about the long term paying capacity including the interest payment. Second is the liquidity position. This shows the short term paying capacity, short term paying capacity of the firm. How effectively the cash conversion capacity of a firm, how effectively a firm, a company can repay its short term liabilities, repay its short term loans, repay for debtors, repay for creditors, repay for the bills payable, repay for the bank overdraft. So, under the liquidity position, the short term paying capacity of a firm is being analyzed, and short term paying capacity of a firm, as we have done with the help of financial ratios, or we may say the current assets upon current liabilities, that is the current ratio. With the help of current ratio, the liquidity position of a company is being decided. If the liquidity position of a company will be high, it means company can easily pay its obligations, short term obligations, and if the company is effectively or efficiently paying its short term obligations, definitely the company's performance will be high, company's image will be high, the goodwill will be high, and company will treated as, company's financials will be treated as the strong financials, where the image of the company in the eyes of the creditors, in the eyes of the loan providers will be high. So, the solvency position and the liquidity position of a company will talk about long term paying capacity, short term paying capacity of a firm. Next is the turnover position. Under the financial aspect, turnover position talk about the sales volume made by the company, sales volume in terms of the capital invested, sales volume in terms of the profitability, sales volume in terms of the fixed assets, sales volume in terms of the working capital, sales volume in terms of the capital. So, the what is the turnover position of a company? If the turnover position of a company will be high, it means the sales effectiveness will be high, and if the turnover is high, turnover position is high, it means the company's market share will be high, which shows the strong financials of a company. A company financial health is depend on the turnover position, where which is being decided under the sales volume. What is the sales volume of a company? If the sales volume will be high, market share of the company will be high, which shows about the more stability of the company, higher profit of the company, higher sales volume of the company, and higher image of the company. Next is the profitability position. under the profitability position, the which is the major or main indicators of a company. Profit, because if we are talking about the financial analysis of a company, we are always talking about the what is the profit position of a company. That profit company is earning the regular profit, the optimum profit, the increased rate of profit or not. So, under the profitability position, the profit earned by the company is being analyzed. If the company's profit position is high, it means definitely company is paying a higher rate of dividend to its shareholders. Definitely company is easily paying the obligations, the liabilities of itself. Company is the employees of the company will feel satisfied. If the profitability position of the company will be high, definitely the market image of the company, market position of the company will be high. So, profitability position is the basic and major indicator of under a company analysis. If the profit position of a company is stable, is under the growing trend, definitely that company is tend to be called as a profit oriented company, and every investor prefer to make in that kind of a company. So, profitability position is one of the leading financial aspect under financial analysis. Next is the operating position. Under the operating efficiency position, operating efficiency talk about how effectively the firms is meeting out its expenditures. In short, we may say how efficiently, how effectively we can meet out our all expenditure in a limited amount. That shows about the operating efficiency of a company. If the company is operating as a low operating expenses, but effectively, then the operating efficiency position of the company will be high. And if the operating efficiency of a company is high, it shows the good financial administration of the company, where the company is spending less and managing more. Operating efficiency talk about spending less, managing more. So, under this operating efficiency, this shows the expenses, how smartly the company is meeting out its expenses. That shows the operating efficiency. Last is the market position under the financial aspects. Market position of a company is being analyzed under the price movement of a particular share, price to earning ratio, the earning of a company, the earning per share of a company, the dividend per share of a company, the dividend payout made by the company. So, these shows the market position of the company. Is the market position under the stock market, company's market position is high, company's share price is in the bullish trend or under the bearish trend. So, bullish trend company always talk about the higher market position, bearish trend market companies talk about the lower market position. Non-financial aspects of financial analysis, of company analysis. These are the non-financial aspects, like the management of the company. What exactly the management of the company? Company's management is professional or non-professional. Employee absenteeism, whether what is the rate of employee absenteeism in an organization, in a company. Employee turnover, whether the employees once employed are stable or there is a high turnover. If there is a high turnover, there is a mismanagement in a company. Technical know-how used by the company, how much technical know-how company is using, what kind of technical know-how, what technology company is using. So, according to the technology know-how, according to the technology used by a company, it is being decided whether the company is a strong company or a weak company. Research and development, the company's research, whether the company is conducting the research activities or not. Companies, what is the outcome of the research activity, what is the level of research activities of a company. So, these are being analyzed under the research and development. Training method used by the company, whether they are using, the company is using the on the job training, off the job training, which kind of training the company is using. The infrastructure, the level of infrastructure of a company. Say for example, if you are talking about the infrastructure, someone has told me कि Google is my to work with Google is my dream job. So, why the question was why it is so. He told about the infrastructure. So, infrastructure of a company talk about whether that company is diversified in various areas, whether what is the infrastructure position of that company. Next is the state of competition. In that company, what is the state of competition? That company is suffering or facing the stiff competition or the normal competition. Say for example, take the example of retail industry, telecommunication industry, smartphone industry. The competition is stiff because of higher government interventions. One of the factor is higher government intervention, or we may say the rules and regulations are in such a manner companies are not easy to follow those rules. And if the companies are following those rules, they are not offering the consumer oriented price sensitive services to the consumers. So, under the state of competition, the higher competition will talk about the lower performance of the company or the market share of the company. If the competition is high, what is the actual market share of that particular company? Next is the corporate image, the goodwill of that company. Take the example in present time, in 2020, the corporate, if we are talking about the corporate image of Indian companies, the RIL, Reliance Industries Limited, is having a higher corporate image in comparison of others, which is one of the reason that the share price of the company is growing up and up or showing the bullish trend. Rest of the companies are also having a very good corporate image, but the Reliance Industries market capitalization is increasing day by day, and they are setting a benchmark for others also. Future plans and expansion or diversity. What is the future? What are the future plans of a company? Accordingly, if the future plans are progressive, growing or growth oriented, then definitely the investor wish to prefer to invest in that company. What are the product range of that company? What is the industrial relation scenario? That company, what is the company's relation with its peer group? That is most important factor. And what is the product life cycle stage? Whether the company's products are under the growth stage, declining stage, in the maturity stage, or in the pioneering stage or the introductory stage. So, according these are the non-financial aspects of company analysis, financial analysis or company analysis. These are the non-financial analysis aspects of company analysis also. So, we may analyze, these are the on the basis of these factors we may analyze the company. So, these are the references where I have taken the references from Nagarjuna, K. Jaiwal, and on the analysis of portfolio, security analysis and portfolio management, and Donald, Fisher and Jordan for security analysis and portfolio management. So, I think we have come out with the strategy of analyzing industry and company to make the investment in a particular stock. Whether to make the investment in that particular stock, particular share or not, it is being decided under 3 steps: economic analysis, then after industry analysis, then after company analysis. So, under this lecture, I have given you a brief about industry analysis and company analysis, where an investor can analyze easily and come out with an outcome whether to invest or not to invest, whether to invest or divest, whether to put more investment, hold the securities or sell out the securities. So, I think we have a little brief or little insights into the investment analysis aspects under fundamental analysis through industry analysis and company analysis. Thank you very much.